I got a really good trading 101 question. Wanting to know difference in market stop loss and limit stop loss. First off, I love the question because it shows this person's mind is in the right place, that of risk management. If you want to find any success as a trader, don't trust me, go ask somebody you do trust, but ask them, hey, what matters more? How much you win or how well you manage risk? And they're gonna say, well, yeah, at the core, it's all about risk management. And at the core of risk management is the stop loss order. But there are two separate types, both the market stop and the limit stop. And that's what I wanna talk about here. But let's just first start at the foundation. What is a stop loss? Well, good news, it's very straightforward. It is something that stops a loss from occurring. So in other words, you were wrong, and that's okay. That happens to everybody as a trader. So you bought at a level and then the price drops down too far and you're saying, you know what, I'm wrong. I need to stop this loss. However, this is where we get into the distinction between a limit and a market stop. And it all revolves around one word, but. Is there a but?
Yeah, but.
What do I mean by that? Well, let's go to the virtual chalkboard and start to walk you through a little bit of price action and the pros and cons of using both of these because yeah, some of them you're gonna look really smart. Other ones you might look and kind of regret the decision. So right here, we're looking at Webull, and I should note that this is nothing unique to Webull. I guess I can't speak for all brokers out there, but most brokers, I assume, have the ability to allow you to do these sorts of stop losses. But right here under order, we're gonna click on that and then just come down to stop. And notice when I click that, it's now asking me right here, stop price. So asking me for my stop price. What is that? So let's just say you buy at $10. And this, I should note, applies to anything, whether that's a stock or that's crypto, whether that's futures, these orders apply across the board. But for example's sake, let's just say you buy a stock for $10. That stop price is you needing to determine, okay, at what location do I have to admit that I'm wrong? And at that price level, that is where I'm gonna put my stop because that is where I wanna stop the loss. So for this, let's just say that line becomes right there at $9. You're saying, you know what, if the price goes down and hits $9, I want to initiate the sell order. And we want to revolve back around that word but. Is there a but? With the stop market order, there is no but. You are just saying, if it hits $9, I want out and I want out now. So price comes down here and hits it. And again, that is where the stop loss is initiated. But this part here is very crucial. Remember $9. Just because your stop is at $9 does not mean you're going to be able to sell at $9. I realize demo and paper platforms may have it like that, but in the real world, there is something known as trading slippage. And trading slippage is just a function of volatile markets. There's imbalances of volume. So in other words, when you want to sell, well, you need a buyer. But if you get some sort of nasty, crazy move to the downside, then you may not find a buyer until, let's just say, $8.75. So that would be 25 cents of slippage because you wanted to sell at 9, but you weren't able to find a buyer until $8.75. That difference is 25 cents. Therefore, that would be 25 cents of slippage. And that's a very real thing. If you go into an order thinking, if my stop's at 9 and I'm gonna get out at 9, you're not being very realistic at all. Usually it's gonna be a little bit lower than that. How low? Well, that depends on how volatile and how crazy the movement actually is. But trading slippage is a very real thing. So let's pick back up with some scenarios that could happen with the price. So in this situation, it hits 9, and let's just say for some reason, nasty move, and it just snaps all the way down there. Well, by the time you find a buyer, you are able to exit the trade. So you're able to exit, but let's just say you finally find that exit and you find a buyer down there at 9.25. Or excuse me, at 8.25. So well, here's a question. How much slippage is that? I wanted out at 9 and I got out at 8.25. If you're saying, well, the difference between 9 and 8.25 is 75 cents, therefore that is 75 cents of slippage, good job. You understand what trading slippage is all about. So in that situation, yeah, that's pretty rough when you consider you had 75 cents of trading slippage. But let me make this situation even rougher. But let's say after you get out, because that was such a crazy move down, the price actually snaps back up before then eventually continuing on down. And these are the situations where the stop limit could help you out, because the stop limit, we have now introduced the word but, meaning, yes, I do want to stop, but I'm only willing to sell down to a certain level. Why would you only want to sell down to a certain level? Well, to avoid what we just showed right there. crazy volume, crazy volatility that can lead to really crazy amounts of trade slippage. That is the point of a stop limit, is you want to avoid those movements where you, whoa, let's see if the price wants to come back up. And then you can avoid those situations. So that's why, and that's the pro of a stop limit, is you're saying, yes, I want to sell, but only at a certain limit. That way I don't get taken advantage of by some sort of massive trade slippage. So in this situation, everything's the same. You bought at 10, your stop price was at 9, but you had the but in there, meaning your limit was, all right, you know what, but I'm only willing to sell for a limit. So the stop limit of, and let's just call that number $8.50. Well, in this situation, I mean, you're looking pretty intelligent, right? Because the people that use the stop market, they got out all the way down there. But you were able to save yourself quite a bit by getting out right there. So yeah, intelligent move.
You know, people don't understand. I went to an Ivy League college. I was a nice student. I did very well. I'm a very intelligent person.
Now at this point, maybe you're seeing the potential flaw in this. Because in this scenario, sure, the stop market people look pretty silly. The stop limit people looked very intelligent. However, let's look at another possibility of what the price could do. So I'm going to keep this other drawing up, but so we can visualize it. But let's just say that this is $9 up here. So that's still our stop number, and the white line is still going to represent the price. And down here is our SL, our stop limit at 850. Okay, so let's do another scenario of what the price could always do. Comes down here, boom, comes up, and then plummets. Notice the high was right here. The stop limit was up here. Hopefully you're seeing a problem here.
And also,
now you are looking at a situation where you're trying to stop the loss, but because the price doesn't come back up to that stop limit, you stay in the trade. And this is the irony of it all. You're not stopping the loss. In fact, the loss is getting bigger and bigger and bigger depending on how far down the price goes against you. And that is the flip side. So there is no, there's no right or wrong reason here, because sometimes, yeah, you'll be able to sit there and play the game of, wow, I wish I didn't do that market because slippage got me, and had I used a stop limit, the price came back up, I would have had a much smaller loss. But other situations, you'll be saying, whew, I'm glad I just got out, because even though there was slippage, had I not just gotten out, that price kept dropping and dropping and dropping and never even really bounced upwards. Whereas this stop limit, people are saying, oh, why didn't I just do a market? Why didn't I just get out when I had the chance? Sure, there would have been some slippage, but wow, now looking at where the price is, that slippage would have been a drop in the bucket. So that is what it all comes down to. Are you gonna say but or not? Are you gonna say, I want out, and I want out just now? Or are you gonna say, I want out, but I'm only willing to sell for a certain limit? And that's that's the difference between a market stop and a limit stop. And I did want to show you what this looked like on the platform here. So again, we have our order stop, but when we go to stop limit, let me ask you this, how many prices are gonna show up when I click on stop limit? If you're saying, well, 2 prices, correct. What would those 2 prices be? Well, again, you need to know your stop price, but you also need to know the limit price. So in our example that we just went through, the stop price was that $9 mark, and then the limit price was that $8, and I think it was 50 cents, or it might have been $8.75. But it was that price. We're on that secondary situation. The price bounced and it never quite hit it. But at the end of the day, here's the but. The but fits in right up there. Stop price, yeah, but only willing to sell to a limit of whatever you would enter into that location there. So I hope this helps, and I hope this shows both the pros and cons to each. So I want to really reiterate, I'm not here to say always use this order or always use that order, because there's a give and take, and maybe it depends on a strategy, maybe it depends on the certain asset class you're trading. So there's some gray area there, but if I did my job right here, you now understand the pros, the benefits to using each one versus the negatives, right? The cons to using each one, because yeah, they both can have you feeling very intelligent, or feeling very stupid as a loss gets super big, or maybe the loss was bigger than it didn't need to be that big. So you're just gonna have to balance that out within whatever your strategy is and whatever you are trading. So I hope this helps. Thank you for the question. If there are any other questions on these trading 101 topics, please leave those down below. I guess I can't promise, but I will do my best to make a video and explain these sorts of answers. But yes, now you know the difference between a market stop and a limit stop. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I've discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only one losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And yeah, the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.